There used to be sort of a scare about technology in compliance departments. I've been hearing a lot of time a pushback saying, oh yes, that would be great, but technology is not yet there. Well, now technology is there.
In some ways, compliance has become a race against time. Financial institutions need to move quickly in the face of fragmented regulations, siloed decision-making, and overwhelming amounts of data. No one knows this better than Chiara Gelmini and her colleague Michael Baldauf, two directors at PegaSystems. Chiara and Michael have spent years helping financial institutions tackle these challenges. And in this episode, they share how simplifying the process could change the game in compliance. They also explain why real-time optimization and AI are essential in staying ahead of today's evolving risks. This is BCG on Compliance, a podcast that explores today's most pressing criminal trends and how compliance professionals are adapting to stay ahead of that curve. I'm Hanjo Seibert. At a time when compliance experts have to move much more quickly, KYC, AML processes, and financial crime investigations have become even more complicated. At Pega, Chiara and Michael are focused on helping organizations streamline decision-making so they can act faster. And the right tech is more critical than ever. As regulations evolve across different jurisdictions and the need for speed grows, the pressure to transform compliance practices is at an all-time high.
Definitely the fragmentation of the legal framework and the complexities that come into being able to comply with the various requirements that are popping up every now and then from the different jurisdictions. That's for me definitely number one. The second biggest challenge, and I'm sick of saying this, but it's obviously around time and timeliness, and there's different facets to it. One is definitely the pace. And then there is a second piece to it, which is being timely in the way that you take on the risk that you are able to identify as a financial institution, perform the right actions, the right investigations, and take decisions very fast. So speed definitely is of an essence.
In my experience, many banks started off to try, let's do that quick and dirty, it might get away, let's just finish and fulfill regulation as it comes, and didn't think about the whole architecture of how could I do that in a digitalized way, how could I do that in an easy way.
And actually, I've seen a little mistrust in technology, especially in the compliance departments. Those are people that are typically risk averse, right? So they like to stick with what they know, what used to work. They're very, very cautious in adopting new technology or even just shifting the way they're used to work.
Great points. And I mean, if I may pick one topic out of what you just said, KYC, because I think KYC stands at the center of a lot of the topics. In summary, what are your views on what have players in the industry, what have they done in your view wrong previously, and what are some of the things that held them back?
The biggest drawback of this, in my experience, is the fact that they ended up with very siloed ways of making decisions about the risk that the specific customer is posing on the financial institutions across various departments and practices. So if an alert was coming in on a same client, on the same risk, there's great possibilities that this was worked independently in different departments in a siloed manner, and so potentially leading to inconsistent decision-making in the end. So that's for me number one, yeah.
And so then looking more towards the solution, what should clients do and how are you helping and supporting some of your clients in transforming KYC and anti-financial crime more broadly?
I think one of the greatest conversations that are popping up consistently is about being able to go for a more holistic and group-wide view, what we call the 360-degree overview on a client and all the risks that they're posing on the financial firm across the different departments. And it's also about the ability of being more collaborative, more proactive rather than reactive and siloed. So there's a constant ongoing ongoing screening of the client that should happen. And this is what in the industry is well known as a perpetual KYC, for example. So more about, unified case management, more about also decoupling the monitoring and detection systems from the case management. So what the financial institutions are trying to do is not to place all their eggs in one basket, rather trying to be decoupling these two pieces and sort of overarching technologies that may vary behind the scenes.
Could you maybe elaborate a bit more on the 360-degree view of the customer? And secondly, on the perpetual KYC that you mentioned, how do you then ensure that perpetual doesn't become perpetual continuously more effort than the historical KYC approaches have been?
The 360 view is giving the client an overview about any risk from AML sanctions, whatever they want to look at. You can also add on ESG or any of the other topics. So basically, based on the questionnaires, the scoring of the client, you can have a real-time view of what am I doing here, who is this, what has changed, and from there, not just have a view, but start cases, start reactions based on changes in the risk profile of the client, which you can monitor on a real-time service.
It may be a little bit scary as a term itself, right? Perpetual, constant, a lot to do. But in reality, it's all about being able to connect the right technology and the right tools so that you have a constant flow of information that you're able to evaluate. And technology will take up a lot of the activities, actually. So it's not about placing more burden on people, it's actually the reverse. It's technology doing it for you. So the idea is to shift him from having a due date, a cadence on reviewing a customer profile every year, 3 years, while with the perpetual KYC, you're ongoingly evaluating changes and micro changes on your customer. So that's a little bit the paradigm shift that's happening.
Let me play devil's advocate a little bit and ask, reality view, the concept you're describing is great when you have a lot of information or accessible information about clients. But let's say, especially in the mid-market segment, upper SME segment, how good is the data really if you're going offshore of well-established countries, let's say like the US, UK, Germany, other European countries? Or is it more a dream where the data needs to play catch up for a couple of years?
In my perspective, data is, yes, a challenge. And it's a bit of the chicken and the egg game here, because you might have one version of a data here, one version of a data there, and then how to bridge the gap in between, how to sanitize your data. That's definitely a starting point. With perpetual KYC, actually, what you're achieving is you are basically ingesting this low quality data and getting them to a better state of quality over and over as long as you proceed with your approach. So that's a little bit the trick.
And that's a great point. And from you having done a lot of projects and tech implementations, can you just give a rough ballpark figure, say for a mid-sized bank, around just roughly budget and timeline? So what do people need to expect when they first think about, okay, do I want to move to this new target state that you're describing?
So for me, the first thing is really about change management and management commitment to the change, rather than, timeline or budget. So I've seen in a mid-sized bank in the UK, this was pretty much the situation. They had their challenges with the regulators. They weren't doing properly their reviews, due diligence. So they decided to hold on, take a step back and say, all right, let me look at this. And they really committed to review the approach and shift entirely to a perpetual KYC approach. They took the time, 6 months, starting from there, adding new use cases so that they could cover more and more of the client base as they were moving along. So I'd say, yes, as a ballpark, with a scoped approach, you can have in 6 months something that's working. I really have other examples like in the Netherlands where it took even 12 weeks to implement something for one country, one line of business.
let's shift gears a little bit and look at the 360-degree view of the customer and the perpetual KYC. How does this ultimately help in being able to take better or different decision-making for your clients?
For me, it's an easy answer. It's about the fact that having a consolidated view of the risk that your customer bears with you as an entity leads to one decision. So basically tying back to what I was pointing before, the risk of inconsistent decision-making coming from siloed approaches to risks inside the financial institution, that is ultimately removed because you're able to have one view, therefore one ultimate decision-making.
So you also mentioned the alerts generation and then investigation. Can you maybe elaborate a little bit more about the integration of this?
What we do is, as Pega is a very integrative platform that easily can adapt to whatever system is out in the market. So what you can get is you get this information together, and now you can add and play all alerts in that group against your own internal risk model or models. And then from there, just triage if this is actually something you want to investigate or something that's actually cleared off already. But the main point is you need to get all alerts that are running in about the same time in the same group of clients or products or lines of business to one view to see what's actually going on in the market. And the integration part and the real-time checking part of thousands and thousands of components and risk models, pulling always the right one in at the same time is what makes it so powerful.
So what I'm hearing there is that perpetual KYC with a single view of the client globally can also help in managing the different jurisdictions and therefore bringing all the intelligence together, regardless of whether that person or a client is transacting in Brazil, Hong Kong, US, or Europe.
Yes, and I think that's the part where it really is necessary to get a really global view. One of our main clients, they centralized their KYC and alert management in a way to only have 4 operating hubs so they can go around the clock, fulfilling all GDPR laws of all countries, but automatically picking the right legislation, their own rules and regulations, to be able to 24/7 monitor any alert in any part, in any country they are dealing in, for any client or group of connected clients in real time. And that not only saved them a lot of money, it saved them a lot of trouble with their supervisors in all of these countries.
But it's also about the ability to view as a centralized department compliance that this client is deemed, for example, high risk in China, but it's medium risk in the UK and it's low risk in Italy, right? So how to structure from there what's needed to be done and the various tasks so that you are having targeted activities rather than having to reinvent the wheel every time from scratch in every jurisdiction.
And now looking forward a little bit, I've heard many times, and you've also said it, that a lot of clients actually see technology as a real game changer in compliance and anti-financial crime. Can you tell me more about that?
Yeah, well, I think this is really what's shifting in the market. There used to be sort of a scare about technology in compliance departments. I've been hearing a lot of time a pushback saying, oh, yes, that would be great, but technology is not yet there. Well, now technology is there, and it's able to actually do what compliance officers and anti-financial crime and anti-money laundering teams need. And they are starting experimenting with the potential and the benefits that technology can give them. I'm talking about generative AI every day with clients. They want to be inspired in what are the use cases that they can deploy Gen AI into so that they can reap the benefit of this technology as soon as possible. It's all about working smarter rather than working harder, right?
And can you give some concrete examples of Gen AI use cases?
So number one case is summarizing information that are scattered in multiple parts of a process. So for example, gaining a customer summary with all the risks that are pertaining to this client and potentially what are the next steps that you want to take in performing the right activity or even proposing the right next product, the right next investment, if we're talking wealth management, for example. The other great use case that we're talking about in financial crime specifically is about generating the narrative for suspicious activity reports. This takes a lot of time and it's a lot error prone as a process. So now with a click, you're able to generate a narrative in two formats. For example, say a summarized version that you may want to use for escalation purposes, and another more detailed version that you want to use to file with your regulator, your MLRO, and so on and so forth. So Gen AI can definitely save a lot of time here.
There's one more thing that we see a lot happening at the moment. And that is actually building software based on Gen AI blueprint. And that's just such a game changer in terms of speed. And that's where we see AI or Gen AI is absolutely helpful to lots of clients. Blueprint is a technology that Pega invented and showed in the last Pega World in July. It basically is a basic web page. And then you prompt the system, I want to do a KYC workflow, and then you prompt what you want to do, and then gives you a couple of questions, and then starts suggesting workflows for you, and then suggests a data model for you. And if you're already a Pega user, you can tell the system to say, I already have the data model, just adapt it, add on it. I already have these integration, use them. And so build it into your existing environment, improve your own processes with the help of Gen AI, based not on a completely open system, but on templates and open intelligence we have built from our own experience in systems.
Let me also ask technology. Where, in your experience, has this also become a competitive advantage with regards to, say, the business? We talked a lot about cost, speed of output, and other things, but maybe focus a little bit on the business side. Where has this been or become a competitive advantage in some of the client engagements you've seen?
For me, it's a lot to do with the efficiency and the level of accuracy that you can gain through technology. I always am very much struck by the fact that we consider KYC oftentimes and due diligence just in the capacity of we need to identify the bad actors, which obviously is the goal number one. But on the other hand, there's some low-hanging fruit that comes with KYC, which is the green flags. Where can I do more business with my client because this is a good actor, right? And that's where you can expand and do more business and get more from your single accounts and your clients to do more business with you. So business benefit in that, more efficiency, more accuracy, speed of execution. And I'd say there's one aspect that's all about being able to reduce the number of so-called touches in the activities that you have to perform with AFC and AML functions, and reaching a stage where straight-through processing is not a dream anymore, is something that you can tangibly deliver at your teams so that you can shift expertise to more value-adding activities.
Let me put that an example from one of our international clients again. They put down their corporate onboarding for new clients from 3.5 months to 5 days. And the other thing is an asset manager in the UK, and they were able for their institutional business to offer self-service onboarding. So they can have their clients on board basically themselves, which makes the whole thing much faster and basically has a far lower risk score.
How much do you see of this a change needed outside of tech? So say a target operating model or an operating model change, being people, culture, the way people think about processes, all the other factors around or other than data and technology. How much of this do you see needed in the future?
Many compliance departments are still bound in past views, and they will have adapt to this. We need to be able and flexible to change and do basically changes every day in every jurisdiction. That is the one big part. And the other big part is we have to go away from this is something on top of the business processes. If we want to have a really good functioning compliance and AML and anti-financial crime topics. We have to integrate those without effort into the usual business process of the first line. They have to come out of there. It has to run in the background, highly automated, not to hinder business, but take what's there and then make the best out of it.
I really think the shift in the mindset is the first step. Otherwise, you cannot realize what you want to achieve if you're not changing the way you're used to. So it requires a shift.
That was Chiara Gelmini and Michael Baldauf from PegaSystems. How is your organization leveraging technology to break down silos and stay ahead of evolving compliance challenges? Join the conversation by connecting with us on your podcast app, writing a review of the show, or emailing us at bcgoncompliance@bcg.com. Be sure to subscribe to get more insights from compliance innovators. I'm Hanjo Seibert. Thanks for listening.